Welcome to The Explainer. Okay, let's talk about something that impacts every single one of us, but feels, impossibly complicated: the economy. But what if I told you it's not some kind of mysterious force? What if it's really just a machine? A machine we can actually understand? So that's what we're going to do today. We're going to take that machine apart, piece by piece. We're going to build a framework, a mental model, right from scratch. And we have to start with the most fundamental question there is. What is wealth, really? Yeah, before we can even begin to understand the mechanics of the economy, we gotta figure out what makes it go. What's the fuel? And trust me, it's probably not what you think it is. So to really get this, let's strip it all down. Let's head to a simple little island. Okay, so picture this. You've got a farmer, a builder, a clothes maker, and a fisherman. And the only money they have are these rare shells. So the builder gets hungry, right? He buys a fish from the fisherman with one shell. Cool. Now the fisherman takes that exact same shell and buys a new shirt. The clothes maker, she uses it to buy some tomatoes from the farmer. And then, full circle, the farmer pays the builder with that very shell to add a new room to his house. So stop and think about that for a second. The shell, the money, ended up right back where it started. The total amount of money didn't change at all. But everyone is richer. Everyone is better off. They all got something they actually wanted and needed. A fish, a shirt, food, a home improvement. Their lives are genuinely better. Okay, but now, what happens if a storm washes thousands of those rare shells ashore? Suddenly, everyone's got piles of them. They all feel rich, right? But when the builder goes to buy tomatoes this time, the farmer's like, no thanks. I've got a mountain of shells already. What am I going to do with more? All that money becomes totally worthless because the real stuff, the fish, the shirts, the tomatoes, the building skills, that hasn't changed at all. And that is the absolute key. This is the big takeaway. Real wealth isn't the money. It's the ability to create valuable things and services that other people want. Money, that's just how we keep score. So with that fundamental idea locked in, let's start looking at the actual machine that runs on all this value. All right, section 2, the economic machine. The economist Ray Dalio has this just brilliant way of explaining this. He argues that the economy, for all its intimidating complexity, really just works like a simple machine. So let's see how he says it's put together. It all boils down to transactions. That's it. A transaction is just you, a buyer, swapping money or credit with a seller for anything. Goods, services, assets. Every single time you buy a coffee, pay your rent, invest in a stock, boom, you're making a transaction. You are a part of this machine. And when you add up all that spending from everyone, that's what drives the whole thing. So Dahlia says there are basically 3 main forces driving this machine. First, you've got productivity growth. That's the slow and steady march upward, the real wealth creation we just saw on the island. That's the bedrock. But then you have 2 other forces that cause all the drama: the short-term debt cycle and the long-term debt cycle. And these are all about credit. They're why we get those wild booms and painful busts. He has this great quote. He says, "Credit is the most important part of the economy and probably the least understood." And think about it. It's so powerful because it lets you spend money you don't have yet. You're basically borrowing from your future self. This juices the economy right now. It pulls spending from the future into the present. But, and it's a big but, you eventually have to pay it back, which means in the future you have to spend less than you earn. And that up and down dynamic is exactly what creates a cycle. And this is where we see the crucial difference between a regular old recession and a full-blown crisis. A recession, that's part of that short-term cycle, happens every 5 to 8 years or so. The government's tool is to lower interest rates, make money cheaper, encourage people to borrow and spend, and get the machine humming again. But a deleveraging, that's different. That's the big one. It's the end of a long-term 75 to 100-year debt cycle. The debt pileup is so massive that lowering interest rates to zero just doesn't work anymore. The machine is broken. That's 1929. That's 2008. Okay, so if the economy is just a machine, you'd think we'd all have the same instruction manual on how to run it, right? Not even close. This is where it gets really fascinating and, honestly, really political. Because people have been passionately fighting over the right way to run the machine for centuries. Just look at this timeline. Every one of these big economic ideas popped up to try and fix a problem the old ideas couldn't handle. They were born out of crises.
You have Adam Smith laying the groundwork, and then a century and a half later, the Great Depression hits, and his ideas don't seem to work. So John Maynard Keynes comes along with a totally radical new approach. It shows you our understanding of this machine is always, always changing.
And really, so much of the economic debate you hear today boils down to this one core conflict. What is the government's role? On one side, you have the classical view from Adam Smith. He talked about the invisible hand of the market. The idea is that the market will fix itself, and the best thing the government can do is just leave it alone, laissez-faire. But then Keynes came along during the Depression and said, "Are you kidding me? Look around." He argued that when things get really bad, what's smart for you as an individual, hoarding your cash, is a total catastrophe for the economy as a whole. He said the government has to be the one to step in and spend money to get the wheels turning again.
Okay, so we've talked about what wealth is, we've talked about the big cycles. Now let's get a little less theoretical and zoom in on one of the most important, and let's be honest, controversial parts of this whole machine: banks. I mean, just look at that number, $25 trillion. That's the amount of assets held by just the top 10 banks in the world. It's a number so big, it's hard to even wrap your head around. But banking started from a really, really simple, everyday problem.
Let's go way back to the 11th century. In Italy, you've got merchants coming from all over Europe to trade, but there's a huge problem. Everyone's got different money. So some enterprising folks set up benches in the marketplace, a banco in Italian, which is where we get the word bank. And their job was just to swap currencies. And from that super simple service, the whole idea of banking just exploded into these massive networks for credit and payments that basically fueled the growth of the modern world. So what does a modern bank actually do? Well, at its core, it's pretty straightforward. They take deposits from people who are saving money, and they pay them a little bit of interest. Then they lend that same money out to borrowers at a much higher interest rate. They're basically turning sleepy, unused cash into active resources for people to buy homes or for entrepreneurs to build businesses. It's a critical function, and it's all about managing risk to help the economy grow. But that process also creates a ton of risk. And we all saw what happens when that gear in the machine completely shatters. Look at the 2008 financial crisis. It was a perfect storm. First, banks got obsessed with short-term profits. They started packaging up super risky loans into these complex products nobody really understood and lending money to pretty much anyone who asked. Then, step 2, the housing market in the US, which was the foundation for all this, collapsed. Those risky assets became worthless. Stock markets went into freefall, and finally, step 3, the whole system just froze. It became a global crisis. We saw massive bailouts, and millions of people lost their jobs. It showed just how fragile that gear can be.
So yeah, the 2008 crisis really pulled back the curtain on some deep problems in the system, and that has led to a boom in alternatives. You've got things like credit unions, which are pretty cool because they're owned by their members, so their goal isn't just pure profit. Then you have crowdfunding platforms like Kickstarter, where you can totally bypass the banks and fund ideas you believe in directly. And you also have things like microcredits, these tiny loans in developing countries that are helping people pull themselves out of poverty by starting their own businesses.
All right, so we've covered a lot of ground, right? We've gone from a simple island with one shell all the way to the dizzying world of global finance. So after all that, what does it mean for you? What's the bottom line? What's your role in this big, complicated machine?
Well, Ray Dalio actually boils it all down to 3 really simple but incredibly powerful rules of thumb. And these apply to you, me, and to the people running countries. First, don't let your debt grow faster than your income. Pretty simple, right? It keeps you from getting buried. Second, don't let your income grow faster than your productivity. This is what keeps you competitive and valuable. And finally, the most important one, do everything you can to raise your productivity. Because at the end of the day, that is where all real, lasting wealth comes from.
And that really gets to the heart of it. The economy isn't some force of nature, It's not like the weather, something that just happens to us. No way. It's a machine that we built. It runs on our transactions, our promises, our trust in each other. And understanding how that machine actually works, well, that's the first and most important step to being able to navigate it successfully. So now that you can see the gears, the cycles, the debates, now that you see how the machine works, the real question is, what are you going to do with that knowledge? Hopefully, you're better equipped to make smarter decisions for yourself, for your family, and for your community. Thanks so much for joining us on this explainer.